think based on everything I'm hearing, they haven't changed anything, and we have support from enough Democrats, and we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
Trump backs a bipartisan deal to reopen the U.S. government, which still needs House approval after clearing the Senate. Flight disruptions and food aid delays are all likely to persist until the shutdown officially ends. But Republicans and the markets are already taking a victory lap. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Stock gains along with commodities and cryptocurrencies on hopes of an end to the record U.S. government shutdown. Bonds are losing steam. We get insights into the markets from a range of voices, including QI Research CEO Danielle DiMartino Booth and Principal Asset Management CIO Todd Jablonski. Trump says India.
We're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us. Again, we're getting a fair deal, just a fair trade deal.
You had it right. Trump says India will love him again, signaling that he is close to a trade deal with New Delhi, which would lead to lower tariffs. We'll look at how the glare from booming bullion prices is hiding deflationary pressures facing China's economy. Goldman Sachs chief China economist Hui Shan joins us for more on this. Also ahead, we speak to Google's Southeast Asia VP on why the region is fast becoming one of the biggest hotspots for the AI ecosystems. And here's a look across Asian markets as optimism grows. The U.S. government shutdown is nearing its end, with President Trump expressing support for the deal. The Senate passed a stopgap funding bill, teeing up a House vote next before Trump can sign it into law. Let's get perspective from Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Prior to QI Research, she spent 9 years at the Federal Reserve Bank of Dallas as advisor to former President Richard W. Fisher. Also joining us is Todd Jablonski, CIO and Global Head of Multi-Asset and Quant at Principal Asset Management. The firm manages approximately $718 billion in assets globally. Todd, let's start with you. It does seem like it is risk on. Relief in the markets. The shutdown is coming to an end.
Well, the markets are certainly validating the risk on trade, and it's been a steady beat as those individual line items that gave investors concern, from perhaps tariffs, latent inflation, war in Europe, we had war in the Middle East, we had all of these forces really, I think, blocking investors from seeing the opportunities, particularly fundamentally, from staying risk on. We tend to like equities, we tend to like credit, and we still like U.S. mega caps. We think those themes can continue to play out as the government reopening, Fed cuts, deregulation, and other forces provide a tailwind rather than the headwinds we have seen.
Danielle, so much optimism. You say the government could be open on Thursday.
Well, that's what it looks like. House Speaker Mike Johnson said that the moment that the House passed the measure, that he would give members of the House 36 hours to report back to their posts in the House of Representatives. They might have a bit of travel delays, however, seeing as the nation's travels snarled as it is. But I think that it's a fair assumption to think that the United States government will be open for business on Thursday, if not Friday of this week. And certainly, again, as Todd was saying, markets are taking that in full stride.
What can you expect in the coming days, Danielle? I mean, first off, will it be, reauthorizing of funding, some of the layoffs being undone, perhaps?
Well, from what we've heard, from what's been agreed upon in the Senate, all of the government workers who had been furloughed will get back pay. And there are also reassurances that there will be no more government layoffs, at least through the end of January the 30th. My caveat here would be that we only have 11 weeks between when the government is assumed to be reopening and the next time that we've got kind of a showdown and a butting of the heads. Some of the members of the Democratic Party were voicing concerns about this because it's such a very short period of time before we're back at yet another stalemate.
Todd, what do you do in the meantime? Keep buying stocks?
Well, we'll have to see how the negotiations play out. That analysis is absolutely correct. The 11-week sort of window doesn't allow for a ton of negotiations. But if I'm optimistic, maybe the two parties can again bring this to the forefront. Maybe we can find a more productive means for the left and the right to try to agree on policy and funding going forward. You know, in the interim, seasonally, typically the end of the year is a good time to invest. And from a fundamental perspective, you're looking at probably 12-13% earnings growth in 2026 across the global complex. There are even faster opportunities available across Asia-Pac ex-Japan. I'd also point to those mega caps, again, that I think are compounding and delivering that steady diet of rich cash flows, those 70% ROEs that you tend to find in the Mag 7. Those kinds of names, I think, are just gaining in fundamental strength, continuing their path forward. I'd be looking at U.S. equities, maybe some spots in the emerging markets like China and Brazil, as well as credit in the coming months to perform well.
But Todd, still so much uncertainty. How do you hedge against the downside? What's best? Do you buy the havens, buy treasuries, buy gold?
You know, when you think about hedges, I think about two that come to mind immediately. The first is I like credit on the short end of the yield curve, but on the longer end of the yield curve, historically, nothing protects better from a volatile episode than owning 30-year treasuries. So point one is I'd steer investors towards long-dated treasuries as being perhaps one of the best hedges against a negative event. Here in Asia, I would actually point towards Japan and Japanese equities as being potentially a safe haven in a downturn. You have the yen being a global sort of reserve currency, a beacon of strength, and among global equity markets, the Japanese equity market features the highest percentage of companies with no net debt. So that avoidance of any sort of debt exposure and the more stable currency makes me think that both treasuries, Japanese equities can be paired as hedges.
Danielle, how are you looking at the risks? Yes, right now the stars seem to be aligned. The shutdown may be easing, maybe opening even. I mean, how are you looking at the risk, though?
Well, we have to bear in mind that the United States government will have been closed for a good 6 weeks here. So there's going to be a lot of volatility associated with the reopening of the statistical agencies. We have a lot of catching up to do in terms of data releases. And when I talk to rates traders, they are anticipating a very bumpy ride because you're going to have one kind of explosive. It's going to be like having one non-farm payroll Friday after another, punctuated by a catch-up CPI report. So there's going to be a lot of fluctuation in markets and heightened volatility going into this December the 10th Federal Open Market Committee meeting. With every data point that's released, there'll be new wagers placed on whether or not the Fed is going to press forward with that subsequent rate cut or not. So I expect a bumpy ride here. Great for vol traders.
So economic fog of uncertainty. Let's take a listen to what some Fed officials had to say.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
And of course, we also heard from Myron, who's pushing for a 50 basis point cut in December. Danielle, what do you make of the different, the three trajectories that we're hearing from the Fed officials?
So, I'm counting the days until the release of the minutes from the most recent October the 30th FOMC, because we know that there is more dissent, more discussion, more disagreement than we have seen in quite some time among Fed officials. There were 7 of them at the September meeting when they placed their dots on the dot plot, who felt that there should not be any rate cuts for the rest of the year starting from September. And let me tell you, since then, they have all identified themselves, as well as the others who are on the much more dovish side of the spectrum. But this is beginning to look like a big ping pong match because the opinions, the views are so very disparate. Many times after the Fed comes out and meets, you'll actually see unity in Fed speak. And right now we're seeing the opposite of that. So we'll be interested to see what Chair Jay Powell himself has to say next.
Todd, your take on it?
I think that investor attention, again, now that we've moved past sort of the shutdown of the U.S. federal government, is going to move towards the Fed, right? That's sort of the key tailwind that yet remains to be defined. I want to build on Danielle's comments. There's been a lot of guessing as to the size and pace of those Fed cuts. And earlier this year, it led to enormous rate volatility. You saw bonds really up into the third and fourth quartile of volatility, mostly on interest rate movements, not really spread volatility. But that volatility has been there as investors, again, try to pinpoint the pace of Fed easing. We expect probably 3 cuts through the end of next year. It's possible you get more. But that kind of tailwind from expansive fiscal policy as well as easing monetary policy, while not in a recession, I think is that rare combination of policy support that does give, I think, backing to the fundamental strength of equities.
And interesting, Danielle, we're seeing a flattening of the curve, 2-year yields higher than 10s and 30s. What do you make of that? This is what, the Treasuries market saying, be careful, be cautious.
I think that is the case, because even though you could argue that all of the alternative measures that we've been going off of for the last few weeks in the fog through which Chair Powell could not seem to navigate, there's great fear about what the official data is going to say. We just came through the month of October, which was the fastest pace of announced public layoffs in 22 years. We've also got the lowest pace of hiring for any October in about the same amount of time. And yet there is great fear right now that the official government data is going to come out and refute some of the on-the-ground real-time data points that we've seen, thereby setting the Fed back and corroborating what Chair Powell said, and that is that maybe we take a step back, maybe we pause in December. I do not think markets would like that.
The thing is, some are expecting a steepening ahead. What do you make of that call?
I think that the steepening call, given that we've gone through yet another day, Frito-Lay here in the United States, Paramount just announced 2,000 more in the way of layoffs. Americans surveyed by the University of Michigan are seeing the highest prospects for a rising unemployment rate in the history of the University of Michigan, outside of one point in 1980. So the flattening, the idea that the yield curve is going to steepen, I think, is validated based on what we're seeing on the ground, because companies are not being respectful, if you will, of coming into the Thanksgiving holiday, when normally you stop hearing about layoff announcements until the new year has come to pass. But that's not what the case is right now. We continue to hear one company after another in a cost-cutting mode and reducing their headcount.
And Todd, of course, inflation remains front and center. Even though the target is 2, we're kind of at 3, and the Fed has been cutting at 3%. What do you make of inflation going forward? Some say that, if we see the full impact of tariffs, you can expect inflation to be 4% in 2026.
Our view is that actually inflation takes a bit of a sort of back seat to those labor concerns we were just discussing. Globally, you find the sort of average level of inflation around the world is around 3%. That's true in the U.S. as well. And while it's over the 2% target, I think the world's getting more comfortable with that sort of 3% level. It's giving the Fed room to ease. I think that, again, inflation concerns year over year might face additional pressure from tariffs. But overall, those tariffs are, again, sort of a one-time event. Once that gets baked into pricing, you do find that sort of begins to wane. And let's go back to the U.S. While you have inflation on goods, again, mostly coming from tariffs, I would highlight that housing inflation is coming way down, right? You're seeing housing prices fall precipitously. That disinflation could give way to a bit of deflation. I'm optimistic that those two forces can offset. And in fact, again, focusing on the labor market is probably where the Fed goes more than that emphasis on price stability.
You know, Todd, President Trump announced over the weekend that every American will receive $2,000 from the tariff revenue. What do you make of that? How might that trickle through the economy?
Well, I'll believe it when my check arrives in the mail. I'm not sure I'm going to be receiving one of those. But overall, what I'd say is from a political perspective, no one's ever unhappy when someone hands you cash, right? It's a winning political strategy to return cash to the voter, right? Directly to the voter is one way I think that President Trump is approaching this in a way that sort of makes it real, makes it tangible to Americans what these tariffs are doing. Look, as an economist, you know, I want to have the largest pie possible globally. I don't know that tariffs help create that. But in terms of a political outcome, returning cash to Americans, just as we did during COVID, proved to be a pretty popular policy.
What do you make of it, Danielle?
Well, I would throw the caution out there in that when you bypass the banking system as the conduit to which to deliver credit to the economy, you might end up with double-digit inflation. In fact, it was one stimulus check, two stimulus checks, and three stimulus checks that actually caused the CPI in the United States to near the 10% level. So I would be very cautious if I was Congress contemplating this proposed DOGE dividend, tariff dividend check, $2,000 to most Americans. I would be very cautious about going down that pathway because it could end up, as was the case in the post-pandemic environment, backfiring in the form of inflation. When you give people with the highest propensity to spend cash, it's going to be spent. And you end up having too much money chasing too few assets, and you end up with the inflation that actually harms the recipients more.
Let's take a listen to what Krugman had to say. He weighed in on the issue as well.
No, it's a terrible idea. I mean, we have an enormous budget deficit. The tariff revenue, which is, by the way, coming in substantially below what Trump administration officials said it was going to be. It's substantial, but it's not what they said it would be. It just makes a small dent in the enormous deficit.
And of course, Todd, we heard from Trump himself saying that those who oppose it are stupid.
I don't know about using that language, but as I'd sort of think about it, right, the tariffs have underperformed in terms of like delivering revenue. But then again, that's not really what this is about. I think fundamentally, yes, you get that sort of delivery of cash as goods come in. But I think what President Trump's policies are built around is trying to nearshore or onshore manufacturing, and that's going to be an uphill climb. The invisible hand and the production of goods in the most efficient sort of elements, that globalization story, I think remains irresistible in the long term. As soon as we get through the Trump administration, I do expect for tariffs to go down, not to where they were before. But I do expect that, again, in this particular environment, I'd much rather see us, again, reduce the level of tariffs. We're now the highest tariff country in the world in the United States, more than doubling Brazil in terms of its rate. That's not where the world's leading economy wants to be. I'd rather see us return to sort of free and open trade, maximize global opportunity. That would be my recommended path forward. In the meantime, though, opportunities as these tariffs drive change in differential rates of return.
A candid perspective today. Danielle DiMartino Booth and CEO, Chief Strategist at Chi Research, and Todd Jablonski, CIO and Global Head of Multi-Asset and Quant at Principal Asset Management. We thank you so much for joining us today. We have some headlines to tell you about. Sony raising its profit outlook. It is stronger than expected by the markets. The company making operating profit of 429 billion yuan. It announced a new 100 billion yuan buyback of its shares with a new fiscal year earnings guidance of 1.43 trillion yen operating profit. Sony now sees a smaller U.S. tariff impact on its operating profit. We also have news out of SoftBank. SoftBank, Provident Capital Partners, and Peak are among a group of prominent go-to group backers seeking to replace CEO Patrick Waluyo, a dramatic twist that could accelerate talks about an acquisition by Grab Holdings. Those are among a group of prominent go-to backers there. Now, still to come, President Trump saying he'll get closer to sealing a trade deal with India after months of difficult talks. We'll have the details coming right up. Keep it here with us. This is Bloomberg. Welcome back. President Trump says the U.S. is getting pretty close to striking a trade deal with New Delhi, which could lower tariffs on Indian goods. His comments signal a possible thaw in the trade dispute between the two countries.
You know, we're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us again. We're getting a fair deal, just a fair trade deal. We had pretty unfair trade deals. They're very good negotiators, sir. Just you have to take a look at that, if you would, please. But we're getting close, Scott. I think we're pretty close to doing a deal that's good for everybody, right?
Let's bring in Bloomberg government reporter Sudhi Ranjan Sen, who joins us from Mumbai. Sudhi, what do we know? How confident are we?
Well, I mean, coming from President Trump, it's the clearest signal that we have seen. It couldn't have come from anybody higher. It couldn't have come from anybody better. We yet still don't know the full details of the deal, as in, where India has accommodated the concerns of the United States, where United States has accommodated India. We're not very clear about that. But the very fact that President Trump has said that India and United States are very close is good news. However, we have not heard anything from India yet. There is no Indian's official statement on it. And in fact, on the trade deal, if we go back, India has been trying to play it down, saying that negotiations are on while maintaining that the relations with the United States are good. They continue to talk. India has kept it at that level, despite the fact that all is not well, so to say, with the India-US relationship, and we have reported earlier that Prime Minister Modi kind of stayed away from the ASEAN summit because he really didn't want to meet President Trump.
Sudhi, even as President Trump talked about, bringing the tariffs down, he said there was a caveat at some point.
Yes, and that is the most important thing. I mean, perhaps down the week we are going to, get to hear either on record a formal statement from India on this, or we may get to hear, or my colleagues may pick up, on background from India. But till then, we'll have to wait that, when this deal is coming through, as to, and the exact timing of it and what exactly it has. And the fact that, President Trump said that makes it all the more mysterious at the current moment. But overall, a very good development.
Sudhi, thank you so much for that. Bloomberg, Sudhi Ranjan Sen, and we're breaking news on the government shutdown in the U.S. The House planning to meet on Wednesday to vote on the Senate bill to end that shutdown, and that's according to House Majority Whip Tom Emmer's office. Again, the House planning to meet on Wednesday to vote on the Senate bill to end the shutdown. Of course, the deal failed to deliver the extension of the Affordable Care Act subsidies that Democrats really wanted, provoking perhaps a backlash within the party itself. And the latest being that vote on Wednesday on the Senate bill to end that shutdown. Still to come, we're taking a closer look at growing ETF demand across Asian markets, especially in AI, with Direction CEO Douglas Jones. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. It is risk on in Asia, but not in China. The CSI 300 index down 0.6%. The other benchmarks like the China Shanghai Comp and the Hang Seng also in negative territory. Bear in mind, though, we've seen a massive rally, especially for the HS Tech shares, currently down about 0.3%. One stock we're watching is XPeng. That stock in particular surging on optimism of a progress in its humanoid robots. We're also keeping an eye on Sony shares, hiking its profit outlook after its anime powers strong performance. In fact, we had Sony raising its profit outlook after reporting stronger than expected earnings, pretty much driven by its strong entertainment portfolio. The company made an operating profit of 429 billion yen. It announced a new 100 billion yen buyback of its shares with a new fiscal year earnings guidance of 1.43 trillion yen operating profit. Sony, by the way, faces an uphill battle this holiday season against Nintendo's freshly released Switch 2. Sony shares currently up by 0.4%. Now, the upstart challenger to South Korea's main stock exchange is banking on offerings like digital tokens linked to K-pop song licenses to build on its strong start and broaden appeal. CEO Kim Hak-soo spoke with us exclusively in Seoul.
We have had two main strengths over Korea Exchange, longer trading hours and lower fees. But both of those advantages are now at risk of disappearing in the long term. Of course, it'll take time for Korea Exchange to fully match what we offer. But over the long term, the distinctions between us and Korea Exchange are likely to disappear. That poses a serious challenge for us. Until now, we exclusively offered the pre-market and after-hours sessions, and that's helped us secure a strong foothold in the market. But going forward, it's no longer just about hours. We'll need to compete on quality.
Let's talk about new business areas. So you have started Nextrade with trading in listed equities, stocks mainly, but do you have any plans for listing or offering trading of other securities such as ETFs?
We're currently preparing to launch ETFs. Our goal is to roll them out by the first half of next year, though there's a chance the timeline could be slightly delayed.
ETF product that the Korea Exchange might be more reluctant to offer trading, you mean? Would that be like some kind of a leverage or inverse ETF?
That's right. There are plenty of such products out there. As Korea Exchange is the main regulated exchange, it naturally has to prioritize investor protection. Of course, we also have those responsibilities, but there are some differences. That means there may be products that Korea Exchange has been somewhat reluctant to handle that we could have more flexibility to offer. That's the point I was trying to make.
I have a question about the fractional investment and security token offering business. So you're one of the 3 consortium that have submitted application for the license. And how would you plan to distinguish your company, and how does this fit into Nextrade's growth plan?
As I mentioned earlier, we should not focus on competing with Korea Exchange only. We should also develop new products. And I believe those new opportunities lie in the over-the-counter market. Looking at global trends, the future of the OTC market seems to be in tokenized securities. There's already active discussion in Korea on that front, and regulatory preparations are underway, although nothing has been finalized yet. Right now, we're working in partnership with MusicHow, a platform that tokenizes music-linked securities. In that sense, our focus is somewhat unique. While others in this space have centered on real estate-backed securities, we're dealing with securities based on intellectual property, especially in areas like K-culture, which has been drawing global attention lately.
Let's talk about the 15% rule, the key hurdle to the Nextrade's growth. On November 3rd, this week, Nextrade has decided to suspend trading of more stocks, including Kakao, which is hugely popular among retail investors. Why did you make such decision?
As trading activity picked up on our platform, we suddenly faced a new kind of challenge. In Korea, there's a regulation that limits alternative trading platforms' trading volume from exceeding 15% of the total trading volume of Korea Exchange. It surprised us and the regulators. So what we can do in the meantime, it was best to comply for now. That's why we reduced the number of tradable stocks on our platform from around 800. This situation undermines both the credibility and the continuity of our market. That's ultimately bad for investors. We're fully aware of that. Of course, the regulation serves a legitimate purpose, but it also has unintended side effects, and the regulators understand that as well. We're in active discussions with the regulators, and the Financial Services Commission is closely monitoring how the 15% rule is playing out. I believe they're taking a flexible stance. I can't say the rule will change overnight, but in the longer term, I do expect to see some changes.
Nextrade CEO Kim Hak-soo speaking exclusively with Bloomberg's Leung Lee. Sony back trading again. Let's do a check on how that stock is doing, extending its gains for the day. It's hiking its profit outlook after its anime power's strong performance. Again, Sony getting a bit up in a big way today, up by about 4%. It sees its financial year operating income at 1.43 trillion yen. It saw 1.33 trillion yen. Now, still to come, Google. Welcome back to Insight. Nobel laureate Paul Krugman says the U.S. currently has the worst consumer sentiment on record, and the government shutdown hasn't helped. Speaking to Bloomberg, he also shares his outlook on the country's labor market.
Basically, we have the worst consumer sentiment about current economic conditions, basically ever. Worse than, not just worse than the 2022 when we had 9% inflation, but
right.
Worse than the aftermath of the financial crisis, worse than the stagflation of 1980. People are really, really down on this economy, and I have to say I don't think that the way this drama has been playing out is going to change that. If anything, we're likely to see, I was just hearing the tail end of what you're saying, ordinary people, people who are not in on the stock market, are hurting and feeling extremely stressed.
Well, Paul, it's interesting that, coming out of this shutdown, one of the consequences is that we're going to get economic data figures to actually put some numbers to this economy's performance. But you think about some of the reports that have been delayed, at least 2 employment reports, CPI, PCE as well. It's unlikely that the BLS has been able to collect and actually process the data for some of these reports. And with that in mind, I wonder, what kind of quality we can expect in terms of trying to put some context around these vibes.
Yeah, we're going to have a ghost month. It appears that on labor market data, there will simply be a month that we know, anything could have happened in there. The BLS will never be able to catch up on that lost data. And we do worry a lot. I mean, there's been a problem with declining response rates and understaffed BLS even before. So the data quality is going to be a real issue. And, we're all looking at the soft data, the private surveys, none of which says that the economy is falling off a cliff, but a lot of which is at least a little bit alarming. And I'm particularly struck. I've been looking at Conference Board on are jobs plentiful or are they hard to get? And that number has fallen off a cliff. People feel really, really bad about job prospects right now in ways that the BLS numbers weren't showing before, but does suggest a kind of frozen labor market in which people, if you're new to if you're young, just getting in, or if you've been laid off, it's a really tough world out there. So this is going to be, it doesn't look like, September 2008 with everything falling off a cliff, but it does kind of feel like this is starting to feel like a tough economy. And as I said, ordinary people are extremely pessimistic about the state of affairs.
And that was Nobel laureate Paul Krugman there weighing in on the U.S. labor market. Here's a look at how Huawei suppliers in China are doing after the morning session. Bloomberg has learned the European Commission is exploring ways to force EU member states to phase out Huawei and ZTE from the region's mobile networks. Our China correspondent Min Min Lo is with us. And Min, what's the concern here? How much enforcement power as well does the Commission really have?
Yeah, those stocks you showed earlier looking pretty mixed, and perhaps this is, something that is still something that is still developing. It's based on what sources are telling us and not official yet. But we know that the European Commission has always been concerned about the national security risk of relying on Chinese companies, the likes of Huawei and ZTE, what they're calling the high-risk vendors. Back in 2020, during Trump's first term in power already, the European Commission had set up what it calls a 5G toolbox, which is a policy recommendation for its member states to exclude these high-risk vendors from the region's telecommunications network. The concern, of course, is that these companies could be subjected to what it calls third-party laws, especially around data security, national intelligence, for example. So it doesn't want to surrender this critical infrastructure to foreign companies. And this is something that is likely to spark a lot of debate in Brussels, because the European Commission now wants to upgrade their policy recommendation to a rule so that countries that don't comply could face some sort of infringement procedure and financial penalty. And right now, only about 10 out of the 27 member states had adopted the policy recommendations, and many countries are still reluctant to surrender their national security decisions to the European Commission.
Min, you imagine that this will escalate tensions with China. How is Beijing likely to respond?
Yeah, for sure, because industry research show that Huawei and ZTE combined still hold about maybe 30 to 35% of the market share in Europe. So if this rule comes to pass, it would have a pretty huge impact on these Chinese companies. And China has played this game before, right? Back in 2020, some of the earlier companies that had adopted the restrictions against Huawei include Sweden, for example, banning Huawei entirely. And China had then pushed back verbally with threats to Ericsson. There wasn't a formal ban on Ericsson's access to the Chinese market, but after the incident, Ericsson's market share in China had collapsed tremendously. It wasn't able to win bids for government contracts from state-owned companies like China Mobile, for example. And already FT is reporting that China is already requiring companies like Nokia and Ericsson to go through a so-called black box security review as part of China's plan to ensure that it's also not overly reliant on foreign technology. So both the EU and China have similar concerns about the security of relying on foreign tech. So both sides looking to perhaps decouple here, and we have to see how negotiations go, because of course China will likely retaliate if this truly comes to pass.
Min, thank you so much for that. Our own China correspondent, Min Lo there. Now, here are some more top corporate stories we are following. CoreWeave reported narrower profit margins in the third quarter as the cloud computing company races to expand its infrastructure and serve more customers. The operating income margin was 4% in the period, the company said in a statement on Monday, missing the average analyst estimate of 6.5% and coming in lower than the year earlier period. Coinbase plans to launch a new platform giving select investors early access to crypto tokens before they list on the main exchange. The platform will use an algorithm to prioritize real users and penalize those who sell too quickly. Monad will be the first token offered starting November 17th. The move follows Coinbase's $375 million acquisition of Echo and could revive interest in token launches once curbed by regulators. And BlackRock has written down a $150 million private loan to zero after home improvement firm Renovo Home Partners abruptly filed for bankruptcy. The move highlights rising scrutiny over how private credit funds value illiquid loans. Apollo and Oaktree also held smaller portions of the debt, which had been marked near par just weeks earlier. Warren Buffett says he's going quiet, marking the end of an era for one of the world's most watched investors. In a letter, the Berkshire Hathaway CEO, who's stepping down from the role at the end of the year, says he'll stop writing the firm's annual letters and speaking at its meetings. The 95-year-old billionaire also says he'll be giving more than $1.3 billion to his family foundations and plans to accelerate donations while he's alive. India's been trading for about 2 minutes now. Let's do a check on how Indian markets are doing. Of course, India got the thumbs up from Goldman Sachs. Now overweight Indian stocks. It expects government policies and improving earnings to help Indian shares catch up with its Asian peers. Of course, this is a market worth $5.4 trillion from the get-go. The Sensex under pressure, flat as we speak. The Nifty index trying to eke some gains there, but it has to do just a little bit more. In terms of the Indian rupee, pretty stable versus the USD. 88.70 is the level we are looking at right now. Now, staying with India, President Trump says the U.S. is close to striking a trade deal with India that would reduce tariffs on Indian goods. Trump earlier this year placed additional tariffs on Indian exports to the U.S., in part to pressure New Delhi to stop buying Russian oil. Currently, the rate on many Indian goods is 50%. Trump says Modi has pledged to wind down purchases of Russian oil and expressed optimism about trade talks.
Well, right now, the tariffs are very high on India because of the Russian oil, and they've stopped doing the Russian oil. It's been reduced very substantially. Yeah, we're going to be bringing the tariffs down.
And earlier, Bloomberg's Paul Allen spoke with former U.S. Deputy Secretary of State Kurt Campbell on how Washington and New Delhi are working to rebuild trade ties.
It's clear that both countries want to try to rebuild relations. Each leader is sensitive about how to do that, but in the background, trade negotiators have really hammered out what I think is a very substantial trade agreement between India and the United States that will take tariffs down from almost 40% to I think a livable range, and you'll see substantial areas where India's markets will open to further cooperation with American tech firms, manufacturing, and the like. So I'm optimistic about this. I would simply say that the most important element of our Indo-Pacific strategy is a strong and growing relationship with India. I was very troubled that relations had fallen to such a low level. Your important question really is, will there be lasting damage? And the honest answer is probably some, but we'll just have to see how deep that is.
Well, I know it's an appealing idea to set aside the India-Pakistan conflict, but at the same time, President Trump is also trying to nurture a relationship with Pakistan, inviting an army chief to visit the White House as well. So how to balance that relationship?
Well, look, I would say almost all our strategic interests lie with India, and I think our engagement with Pakistan is substantially different and much less significant since the Cold War and the period thereafter.
But nurturing that relationship does risk alienating India, correct?
It does, and it is also the case, and I think we just have to be honest about this, Paul. Really, it is Pakistan that is more, shall we say, effectively engaged the Trump family with a variety of engagements on cryptocurrency and resorts and the like. But still, the most important relationship for us is India. We should not just tilt towards India, we should fundamentally embrace India.
Bloomberg's Paul Allen speaking with former U.S. Deputy Secretary of State Kurt Campbell. Let's do a quick check on how Japanese stocks are doing. They are extending the rally today on the back of the strong earnings we're seeing from the likes of Sony, and also in anticipation of SoftBank's quarterly results, which may further lift the mood, especially around tech. Signs that the longest ever U.S. government shutdown is also reaching an end. That's boosting risk appetite as well. The Nikkei 225 currently up by 0.4%. Taking a look where we are in terms of those Sony shares, it is trading up, extending the gains for today, up by about 6%. Sony, of course, hiking its profit outlook. Anime powering its strong performance. For more on earnings season and the numbers out of Sony, let's bring in Bloomberg Japan stocks reporter Alice French. Alice, when you take a look at the earnings out of Japan, it does look like that rally is sustainable going forward.
Absolutely. I mean, things look, almost endless at this stage, right? It just seems to be good news after good news. We, like you say, we've had Sony just in the last hour coming out boosting that profit outlook, also saying that they expect a slightly smaller impact from tariffs than they originally feared, which of course is helping sentiment. As you mentioned, stocks up almost 6%. That's helping the whole market, really driving up the topics higher as well. You also mentioned SoftBank. Now, of course, we know that SoftBank has been one of the main drivers of the whole market rally so far this year. It's up over 140% since January, obviously mostly on sort of excitement around all of these AI investments it's doing, not least the Stargate project over in the US. And we have those earnings coming later today. It seems like a lot of investors buying into those tech shares kind of in anticipation of what's going to come out of SoftBank. We've also seen, obviously, Sony, we know, gets some of its profits from gaming and IP. The Demon Slayer movie that came out recently seems to have helped their earnings. We know that Nintendo as well had a pretty good run in its earnings the other day, raising that sales target for the Switch 2. All of this kind of bullishness driving the Japan market forward overall. Now, of course, we're up at new highs. We actually saw the topics hit an all-time intraday high earlier this morning. There are some concerns of kind of a bubble of some overheating, especially on those AI stocks. And I do think the SoftBank earnings will kind of be a make or break moment. Expectations are high. Investors kind of really need to be shown the money in terms of where this AI investment is actually going and how it's contributing to earnings. And so I think it's going to be a key test, and we'll have to see if the rally is still going tomorrow, but certainly on the ground, the mood is optimism.
The mood is optimism. You mentioned perhaps concerns about overheating. What are the other risks that might be playing out in the Japanese market?
Yeah, it's a good question, right? I mean, of course, the yen is always hanging over this. We know that it's still pretty weak around that kind of 154 mark. Of course, we know that there will be a BOJ rate decision at the end of this year, potential for another rate hike, and that could potentially weigh on equities. We know that, the topics, for example, gets less of a boost from the weak yen than it has been in recent years. As you mentioned, of course, this bubble, this worry about overvaluation. I think, there are kind of jitters around that here, just as there are in the US. And of course, we do still have kind of geopolitical elements hanging over this. Tariffs, Sony saying that the impact is smaller than they thought, but we have seen some companies coming out, for example, Sanrio, which makes Hello Kitty, saying that actually the impact from tariffs was more than they expected. So there are still those risks happening in the background, and I think investors are sort of taking earnings at face value and kind of doing some stock picking there and finding the winners and losers. So there are definitely risks, kind of in the background there, but at least in the short term, there seems to be excitement, earnings overall kind of better than expected. And I think we can expect, at least in the kind of short to mid term, for that optimism to be driving the rally further.
Alice, apart from the AI theme, any other themes that we should be looking out for in the Japanese market?
Yeah, so if we look domestically, right, we know that we had this new prime minister, the first female prime minister, Takaichi. Now, she has been talking about these kind of stimulative policies, right? So she wants to put more spending into things like tech, but also things like defense, cybersecurity, infrastructure. And we have seen, defense shares, for example, in particular, gaining a lot on expectations of sort of higher budget infrastructure as well. Construction has been doing pretty well. There's also been some talk of potentially cutting some consumer taxes or increasing consumer income. And so we may see sort of things like retail gaining on that. We know that Uniqlo, for example, has been seeing its sales do pretty well. So I think outside of AI too, that there are options to go for here.
Alice, you got to go. Thank you so much for that. Japan Stocks reporter Alice French. Now, here's a look at our guests in the next hour. StashAway will be joining us to unpack the market. More ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian markets rising for a second day on growing optimism. The U.S. government shutdown is nearing its end. With President Trump expressing support for the deal, the Senate passed a stopgap funding bill, teeing up a House vote next before Trump can sign it into law. Let's get the latest on the push to end the U.S. government shutdown with Bloomberg government editor John Huskowitz. John, what do we know? This 41-day government shutdown coming to an end soon.
In theory, it could end this week. So the Senate just passed the bill. It's gone over to the House. The House is supposed to take it up on Wednesday in Washington. Speaker Mike Johnson says he expects it to pass. The Freedom Caucus, the hard right part of the Republican Party, the leader of that has shown conditional support for it. But the Republicans have a very small majority in the House. There are a lot of members there. There are a lot of things which could go wrong and derail it. And the Democrats have shown opposition to it. And even Democratic House Speaker Hakeem Jeffries is opposed to this. So at the earliest, it could end on Wednesday. At the latest, we could see some things that just derail the process. But the Republican leadership sees the prospects of it ending this week as something that should happen.
John, if the shutdown ends this week, what can be anticipated? What are we looking out for?
Okay, the actual provisions of the deal include funding for most government agencies through January 30th and full-year funding for Agriculture, Veterans Affairs, and Congress. The furloughed workers will return. They'll get back pay. Those who've been laid off can come back. So all of the stuff that has been shut down will start getting money again, from TSA to air traffic controllers to all parts of the government if the measure goes through. So we'll see the U.S. government up and running once this happens. Some parts of the government will fare better. Those three agencies just have the full year funding. And we're also set up for another confrontation in January when that funding runs out. Sorry, a possible confrontation. Don't want to get too far ahead of ourselves.
What are the Democrats saying about the deal?
Now we have those in the Senate who broke from the party to sign the deal said that this was the best thing that could happen. This was inevitable given the situation. But there's a lot of anger in this. The Democrats came to this conclusion that they were going to force this, that they were going to have this shutdown. And they wanted to see an extension of Affordable Care Act subsidies, which were due to expire, which without these subsidies, millions of Americans would see their health insurance costs skyrocket. The concession that Republicans gave was allowing a vote on the extension of these subsidies in December. Whether these subsidies pass or not is another matter. For a lot of members of the Democratic Party, especially on the progressive wing, they see this as a betrayal. This was the root cause of their confrontation with the Republicans, and they just don't like the way that it has been settled. So there's some fissures in the Democratic Party. We'll see how this plays out in the House, but there's discontent among a large number of lawmakers about the deal that was reached.
John, thank you for that. Bloomberg government editor John Huskowitz there. Let's discuss the market impact with Stephanie Leung, CIO of StashAway, a digital wealth management platform. Steph, it does seem like, we could see pushback within the Democratic Party. For now, though, it's all systems go. It is risk on.
Yeah, indeed. I think if you think about the government shutdown, to start with, the market was never really worried about it. I think it was only in about past maybe 2 weeks or so where you've seen some sell-off in risky assets and also non-risky assets, including gold. So I think it's sort of a combination of, number one, the valuations getting a bit rich. I mean, a few of the trades got a bit quite crowded. And then secondly, of course, the government shutdown itself is causing some sort of liquidity drain from the system. But if the government restarts, I think that liquidity is actually coming back to the system. And that's why the market is cheering on that potential rally into December. Added to that, of course, seasonally, you have typically pretty good equity returns during the month of December. So I think market is actually looking forward to a Christmas rally right now. Of course, a lot has to be done, but I think that's a big step towards kind of waiting and not knowing when the government shutdown will end.
We talk about how the market's price for perfection is not just the stock market, but across asset classes. How is that even possible? Is this driven by liquidity in the system, and that liquidity is getting boosted even more with Trump planning to give every American $2,000?
Yeah, absolutely. I think if you think about what has really changed in the past few months, one of the most notable thing is, of course, the Fed restarted its rate cutting cycle. So that is a plus for liquidity in the system. The other thing that was happening was, of course, on the counter side, the Treasury has been rebuilding its Treasury General Account, the TGA. And if you look at this TGA, it has a balloon from about 300 billion to now almost 1 trillion. Part of that is a normal rebuilding of that TGA account, but part of that is because of the government shutdown. The Treasury was not paying like the workers, for example, or not doing a lot of outlays. And that's why this liquidity is stored in the Treasury accounts. And I think that was a counter-opposing force on liquidity versus the Fed loosening. And therefore, that caused a bit of like market reaction or market, I guess, kind of concerns on liquidity in the past 2 weeks. Also, if you look at some of the money market, rates, and they have been showing quite tight kind of concerns on reserves being too low. But again, I mean, the Fed has taken a big step, right? The Fed has actually announced that they will stop the quantitative tightening program starting in December. So I think there's a mix of I guess, factors affecting liquidity. And with the Fed, with the, I guess, government reopening, one of the biggest drag on liquidity, which what I mentioned was the TGA account rebuilding, will be reversed, and it could be reversed quite quickly. So there's a 1 trillion liquidity stored in there. So that is quite significant. And I think that's why you see like risky assets, you see safety, even safety assets like gold rally on the back of this announcement.
There's been a lack of data fog, if you want to call it that. And on the back of that, we've had 3 Fed officials suggesting 3 separate trajectories for the Fed. How might that risk play out? I mean, we have the likes of Myron saying that, you know, he's pushing for a 50 basis point cut in December, and the likes of Daly saying, you know what, maybe that's not the case.
Yeah, indeed. I mean, in the last FOMC, it was a very, very first time where we've seen 2 dissents and one on each side. Right? One of the dissentants was calling for more cuts. The other dissentant was actually calling for no cuts. And I don't think that has ever happened in the Fed's history. So there is quite a bit of debate, even within the Fed members, as to, I mean, what the interest rate path should be. And indeed, if you think about the December FOMC meeting, I think that's a very, very live meeting, and it could go either way. I think Powell kind of hinted that it's not a foregone conclusion that the Fed is going to cut. And indeed, as you mentioned, with the data coming back in, there would be some nervousness in the market as to, I mean, whether or not that affects the Fed's last meeting. So, I mean, our view is that if you think about the economy right now, it's sort of like a 2-speed economy. And I guess in the latest piece that we write, we title it AI runs hot, jobs run cool, but the Fed actually runs loose. And I think that is sort of the undertone of what's happening. AI investments are supporting the economy. And if you look at kind of the GDP growth, for example, in the US this year, a lot of that has been made up for by the CapEx investments by hyperscalers and the likes. On the other side, if you look at the labor market, indeed, a lot of signs are pointing to slower labor markets, be it because of the trade uncertainty in trade tariffs, a shift in the labor market due to the AI revolution, or even, I mean, just a lot of the companies not realizing the earnings and therefore has to sort of cut in terms of the expenses. I mean, all these are contributing to the weakness in the labor market. And at the end of the day, we think for the Fed, they're still leaning towards a more preventive measure in terms of not actually letting the economy slide into a high risk of recession. And therefore, our view is that the Fed will continue to run it quite loose. On the, I guess, if you look at beyond the next meeting, of course, The biggest question is next year when Powell actually rotates out of the Fed. I mean, who's going to take his helm? And I think the market is looking towards a more dovish chair at the Fed, and that is also supportive for a continued interest rate cut path as well.
Steph, some are suggesting that QT would quickly make way for QE. When you take a look at the liquidity that we've been talking about, the financial conditions seem to be quite okay, pretty loose. But when you take a look at monetary policy, that's tightening quite quickly. What do you make of that? Do you see that happening?
Yeah, I think but it comes down to technicality right now, really. If you think about the reason why the Fed is actually removing QT in December is because in their judgment, the reserve level is not keeping up with nominal GDP growth. So therefore, when you have a certain size of an economy, you need a certain level of reserve. So potentially, yes, I mean, there could be QE if they determine that the size of reserve needs to be bigger to accommodate for a bigger economy. But it's very, very different from the QE that we've had before, right? The scale, the magnitude and the impact is actually much smaller. I think what's more important is, of course, like the interest rates path, because today still, you can argue that real rates are still relatively quite high versus history, and therefore the Fed has room to cut. And then I think more importantly is what happens on the fiscal policy side. Because I mean, the U.S. Growth is still very much supported by the significant amount of fiscal deficit that the government is running. Indeed, if you look at kind of the level of fiscal deficit at around 5, 6, 7%, I mean, these are unprecedented in terms of peaceful times, in terms of times where there's no crisis. So a question is going forward, I mean, how can the U.S. sustain this kind of level of spending? And this is not just happening in the U.S., right? Also, I think in other parts of the world, in Europe, for example, in China, in Japan, what is fiscal policy doing to impact kind of the cyclical cycle? So I think that is perhaps more impactful, more meaningful than the technicality of doing QE or QT.
So how do you position for the next 12 to 24 months, Steph?
I think as long as like liquidity is still loose, and I mean the Fed is still on a loosening path, the US dollar is still kind of on the weaker side, these are all supportive risky assets. Now, of course, a big question right now is AI in a bubble? Because I think AI currently, I mean, not just drive the Max 7, but a lot of other kind of markets as well, of course, including the Chinese market. Our view, or kind of judging from the data that we see, we think that, I mean, of course, like some of the valuations are a bit frothy, but I think it's too early to talk about the burst of the AI bubble. Because when we study kind of historical bubbles and when we study kind of systemic crises that were in the past, most of that is actually driven by leverage and credit cycles. And today, even though we talk about like very, very large numbers for AI investments, a lot of that is still supported by cash flows. Corporate cash level is still very, very healthy. And interest rate spreads, credit spreads are still quite low relative to history. So I think that can still go on for a bit. And of course, there will come a time when perhaps like companies get levered up, but I think we're still quite a few years from that.
How about in terms of emerging markets? Will their moment finally come?
Yeah, I think perhaps in 2026, one of the more contrarian areas is actually emerging markets. And I think with the lower interest rates and also weaker kind of US dollar, I think it is actually quite a conducive environment for emerging markets. Indeed, I mean, if you look at like China market this year, it has performed very well. Other emerging markets have done very well as well. But I think that is just kind of the catch-up trade of people being underweight to being market weight. I think if you look at China, still the AI story is not as developed as in the US, but I think we're seeing kind of productivity gains and revenue gains from some of the bigger names in this space. So I do think that this is an area that maybe in 2026 it gets more attention by global investors.
Great perspective there, Stephanie. Thank you so much for your time. Stephanie Leung, CEO of StashAway. Still to come, Google joins us to discuss their latest report on the state of the digital economy in Southeast Asia. We'll discuss why the region is fast becoming one of the biggest hotspots for the AI ecosystem and where the opportunities really are. Keep it here with us. This is Bloomberg. Welcome back. Southeast Asia's digital economy is on track to surpass $300 billion in gross merchandise value this year. That's according to a new report by Google, Temasek and Bain & Company. Let's discuss this and more with Sapna Chadha, Vice President of Southeast Asia at Google. Sapna, good to have you with us. Talk to us about the catalyst for this massive growth we're seeing in Southeast Asia.
Yeah, we are seeing tremendous growth. We're 3 years ahead of where we thought we were going to be at $300 billion, 1.5x what we were expecting. And this is driven on the back of many things. Once we've seen extreme digitization. We've added over 200 million users in this last 10 years. You have macro fundamentals of this region, which are looking great. The competitive economy with payments and super apps are leading to innovation and creativity and drive like we haven't seen before. And this has led to what I would say what's most interesting in terms of inflection is really the profitability of the businesses that we're seeing. This shift to profitability, businesses are showing the returns, and this has led to investors investing more. And we've proven this in the report by really shifting just from tracking GMV to also revenue. And revenue has grown 11x. And so the business fundamentals are really what is driving this catalyzation right now.
A lot also has to do with AI. I'm just wondering where the most transformative AI opportunities link to Southeast Asia.
Well, I think what we're seeing is that this region is one of the most AI curious regions in the world. So it really starts with the consumer. We're seeing almost 3x what we're seeing in other parts of the world in terms of AI curiosity. On everything from multimodal AI to agentic AI, this region is intensely curious. But that's also leading to real impact in businesses. You know, our investor portfolios, as we've shown in the report, many of them, 86% of them, are seeing returns on the investment that they're making in terms of cost savings, and 70% are seeing revenue uplift. So you see this, the efficiency on the expense side, you see top line growth on the revenue side, which is leading to more confidence from the investor ecosystem. That in turn is leading into upskilling that's happening in the region. We are seeing this pull where users are saying that 8 out of 10 of them are saying that they're using AI. Half of them are saying it's essential in their daily lives. And that is creating this pull on talent, on upskilling. And it's creating this flywheel, right, that I don't think any of us ever expected would be so profound, especially so quickly. We've seen changes in history. We've seen, obviously, when mobile started, when the internet started. But what we're seeing here is things are happening faster than we expected, and the returns are also faster than anyone expected.
We focus a lot on the consumers, but we have to take a look at the small businesses. SMEs represent something like 700 million, right, in this region alone. I'm just wondering how they're adopting AI. How effective has it been for them?
Yeah, no, you raise a really good point. One of the areas I'd point to is commerce, right? So commerce has been, on the back of large players, but what we're seeing is a shift to video commerce. 25% of e-commerce now is video. And this is on the back of growth from sellers who are small businesses, who are merchants, also creators who are tapping into this ecosystem. Southeast Asia has one of the most video-engaged populations, and small businesses are taking advantage of this moment. So we're seeing growth in live commerce and all forms of video commerce. And this is leading to transactions growing faster than were expected. Transaction price or average order value is lower, but we're seeing that overall transaction volume is going up. And this is where the small businesses are using a lot of AI tools, right? We're seeing this adoption on our YouTube products, but across the board, platforms are seeing adoption of AI tools by small businesses and merchants really take off. And this in turn is then leading into the growth of the economy because commerce is still the undisputed champion of the digital economy.
Are there funding gaps currently as the 11 nations in Southeast Asia, embrace the AI digital economy?
Yeah, we have lots of data in the report. I think what we're seeing is definitely a stabilization. We have seen growth in private funding of 15% in the last year, so positive signs. I mean, the expectations are clear, right? The expectation is we want to see profitable growth. We want to see great fundamentals, and businesses are responding. And so it's leading to that stabilization. We're optimistic when we look at the IPO pipeline of what's in play at this time on where this could go. And we're also seeing that the funding has moved to more late stage, right? So I think in previous years, you would have seen rapid expansion in early stage funding. Now we're seeing that's moving to late stage. We're also seeing certain categories get more attention. They're the ones that are delivering, like digital financial services. So funding is improving. We're optimistic as we go forward, and I think I think we've taken these last few years to really get the fundamentals in place, which will create that optimism.
We often talk about how Southeast Asia is a great space for, digital consumers. How about Southeast Asia as an innovation hub, an AI hub? Where are we with that, and what's the potential of that pivot?
Yeah. Well, I would say, I think if you want to look at an area that is getting more attention is really in the infrastructure. And this is where private meets public partnership, right? I think we're seeing governments leaning in and investing in data centers. I think that's one really good measure for us to look at. Data center growth is expected to be 180%. We're seeing billions of dollars flow into this region. We as Google have invested in our infrastructure in this region. Last year, we committed $2 billion in Malaysia. We've committed in Thailand. We're continuing to commit to this region because of Southeast Asia's potential and the opportunity that it has to play in this next decade in terms of this AI moment. And so what we're seeing is that we're going to have an outpaced versus the rest of Asia in terms of data center capacity. 4,600 megawatts are planned for next year, right? So this is higher than we expected. And I think what's leading to this is a few things. One, you have Singapore, which has traditionally been a focus area, has become more capacity constrained, which is leading to us investing in the rest of the region. Also, data localization requirements from Indonesia and Thailand are also creating more urgency for us to do this. But again, it comes back to this demand that we do see from the customer, which is meeting the needs of the consumers and their rapid adoption. And so we're going to continue to see a growth in this area. And what's key is the public-private partnership. The grid has improved, 5G has improved, and so this is leading to the growth.
Sapna, thank you so much for that. Sapna Chadha of Google. Now, in the markets, of course, it is a positive day as investors cheer the prospects of that government shutdown in the U.S. coming to an end. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. It is my favorite day. China's Singles Day shopping extravaganza is now in its 17th year. However, shifting consumer behavior has transformed the traditional one-day sales blitz into a weeks-long campaign. Bloomberg's chief North Asia correspondent Stephen Angle brings us this report.
Influencer peddling is all the rage in China. Online, of course, but now more than ever before, on the actual trade fair floor as well, where rapid-fire hawking of product over multiple mobile phones direct to China's billion-plus consumers has never been this, well, in your face.
I don't know how they talk so much. Everything you would possibly need to know about Vietnamese iced tea.
And other products from overseas. Doesn't matter if it's New Zealand milk powder and ice cream or Italian cleaning supplies, complete with a Mandarin-speaking European. They're all competing for Chinese cyber shoppers in a market where around 40% of all retail sales are now done online.
A single day 11/11 is huge. We have a strong presence on online platform and we have a strong focus on Gen Z.
I know Singles Day had another few more weeks to go, but so far the result has been very, very encouraging.
Online shopping in China is growing at 3 times the pace of traditional retail, with many brick-and-mortar outlets feeling that pain. CPI did pick up slightly in October, but overall retail spending is expected to have slowed again as households hold on to savings amid economic uncertainty. Add to that are lingering worries importers and exporters here feel about the fragile trade truce with the United States.
High tariffs are hurting everybody, hurting both sides. One of the things that as businesses we do hope is that there is longer than a 14-month detente, shall we say, but that there is some general baseline of the relationship. These are areas we're going to trade in. These are areas that are no-go. This is kind of a gray area where we'll keep negotiating on, because that would help us all, to your point, really understand what we can move forward. And if I do want to have a 5-year contract with an American supplier, I know no matter what, I'm going to get that product.
I think it's been critically important that we have clarity.
U.S. wine exports to China this year were down 77% in the 7 months through July from a year ago, with Chinese tariffs and taxes combined amounting to about 75% on American wine. And yet Barros is cautiously optimistic for a recovery, as the truce has kept tariffs from escalating further.
It was a very, very positive development that they came up with an actual number that's going to be in place for the next 14 months. Because before that, I think a lot of importers weren't so upset about the tariff. They didn't know what it was going to be. And so now we know what it's going to be, at least through the end of December of 2026. And I'm hoping that that brings some normalcy back into the process.
It's an endurance game shared in some respect by the many influencers in nearby booths, to keep talking and to keep the parties on the other end engaged. Stephen Engel, Bloomberg News, Shanghai.
Now, for more on what we can expect from Singles Day, let's bring in Bloomberg Intelligence senior analyst Catherine Lim. We say it's Singles Day. It's actually Singles Week because it's been extended by 5 days. What are the indications so far? Because this is China's biggest shopping event.
It is one of the longest, too. You know, if you think about it, actually started early October this year. It's more than a month long, right? 39 days to be exact. And Alibaba and JD will only be closing their campaigns on the 14th of November and no longer the 11th of November. So there we have it. But again, you know, lots that's going on. And I think this year, what is interesting is that we're getting services, fast deliveries, 30 minutes, 9 minutes, the latest from JD.com. Being able to actually get your goods really speedily. Well, that's what you have for Singles Day now.
It is about subsidies. It is about discounts. You got to wonder whether this time round, given, the China's economy, are we seeing deeper discounts, and what is that looking in terms of impact on their margins?
I think my observations is that, definitely it has been deeper. If we take a step back, early October, I think it's quite well known that in Greater China, particularly in the south, the weather has been fairly challenging. I was there in China and seeing all the autumn-winter clothes up when it is like a slithering 30 degrees out there. It's been really slow for clothing and some of the appliances. I think things really got better just the last 2 weeks itself. And we've actually seen more perks coming through from Alibaba, JD, Douyin, and Kuaishou as well.
So what does it mean for the numbers going forward? Maybe not just the fourth quarter, but, in 2026, how much optimism is there?
That's a great question because, they're going to set the tone for it over the next 2 weeks, and starting this Thursday with JD.com reporting third quarter results. Now, we all know that earnings going to be down and in the high double digits. It's going to be a bad third quarter because Meituan already said that they were going to sink into losses because they are investing. So the trajectory into 2026 really is that, will we be able to narrow some of these profit decline as we go along, and if sentiment actually does improve in China?
The thing is, this is against a backdrop of a Chinese government that's actually providing a boost in consumption, right? Stimulus. It isn't working.
Yeah, I mean, how much stimulus can you, give put out there. And the reality is that how many washing machines can you possibly buy every 6 months?
2 max.
So I think that's the million-dollar questions. And even if we talk about shorter replacement cycles, whether it's your iPhones, etc., right? The reality is that there is a limit to how much consumers can digest.
So what are some of the key things that you are looking out for the quarters ahead? What's key?
Well, again, I think what is interesting is that, most of the platforms right now, they are looking to actually lock in users and trying to turn them into loyal paid members. And that is what essentially they are trying to do over the latest Singles Day. So I do think that you will start to hear more of the companies talking about how they're going to connect the members together across multiple platforms so that they can actually enjoy, more services, etc. It's about making your users more sticky. And, fingers crossed on that one.
And who are the likely winners on the back of that?
Well, Alibaba has a very huge ecosystem. We all know that from payments right now to, whether it is their e-commerce as well as their AMAP, etc. So I do think that, they are in a sweeter spot than other platforms.
Catherine, thank you so much for that. Bloomberg Intelligence senior analyst there, Catherine Lim. Now let's get perspective from Hui Shan, chief China economist at Goldman Sachs. Hui, give us your take on what you're seeing in terms of the Singles Day. How much is that a reflection of the macro environment in China?
Thanks. And I think the tepid picture of the Singles Day sales tells you that the macro picture for household consumption hasn't changed that much. With all the macro backdrop we discussed over the past few years, the property, the job market, the deterioration in expectations going forward, that translate into more conservative household behavior and more risk aversion in deciding how much to save versus how much to consume.
So the government push to boost consumption is not really translating to spending. What more does the government need to do to change that?
I think there are a couple of sort of considerations here when you think about household consumption. In your conversation with Kathleen, and you guys are talking about purchase of the different categories, the goods versus services, the home appliances. But end of the day, I think the key is to have income, have a better confidence about future income. If you don't have that income flow, you don't have the money to spend, then it's a bit like a zero-sum game. You go to ski, then you don't go to the beach. And if you watch a movie, then you don't play the game. So I think it's really key to remember that income, end of the day, will translate into higher consumption. And I think from the Fourth Platinum and 15th Five-Year Plan proposal, there are discussions about increasing household income. However, that's not an easy task, and we really need to figure out how to do that. Until we see that, I think consumption trajectory at best will be a gradual recovery.
Right. So in your opinion, which policy levers would really move the needle? Still fiscal, monetary policy, credit? I mean, what policy lever would best suit that?
In our view, if you want a more sustainable consumption growth, there are a few things you can do. You can increase the wage share of GDP, whether that means a modest increase in minimum wage or having other administrative measures to make sure that the wage share of total income continue to increase, providing the social safety net, whether it's unemployment insurance, whether it's retirement savings, whether it's beefing up your healthcare system, giving people the peace of mind to spend. And it is also thinking about removing restrictions, allowing businesses to provide higher quality services and creating more settings or products that people really want to consume. I think it takes a holistic set of efforts. It is a monetary fiscal, but it is also administrative. It is also structural.
Given the continued weakness in consumption, does that impact the way you look at China's GDP? Would that prompt perhaps a revision in your own estimates for the year, for next year?
Yeah, so if you look at the couple weeks ago, we actually made the largest upward revision to our GDP forecast in a decade. And that's not because we're uber bullish on household consumption or domestic demand. It is more driven by the policy direction that industrial manufacturing, high-tech innovation, that part of the economy, the government is doubling down and will push very vigorously. At the same time, the Trump-Xi meeting told us that with China's ability to control rare earth and other critical minerals, it will be somewhat difficult for other countries to push back against Chinese exports. So you put two and two together, the Chinese government is doubling down manufacturing. Other countries find it more challenging to impose trade barriers. So therefore, we upgraded our export forecast for China and lifted our GDP forecast next year, for example, from 4.3 to 4.8. 2027 from 4.0 to 4.7. These are large upward revisions, but it's not because we're very bullish on household consumption.
So rare earth is one, AI is the other. You got to wonder how effective China has been in capturing the AI growth and translating that to its domestic economy.
Yeah, I think directionally we can be very confident that's the direction the government is pushing for. Compared to the U.S., China has advantages such as plenty of energy supply, power supply, versus access to advanced chips that might be a bottleneck that the government is working on. I think directionally, you look at the official communication, the official documents coming out of Beijing, it's very clear this is one area the government is zero focus on driving innovation and combine AI and intelligence and digitalization, all these advanced technology into what they call the modern industrial system. This is where we are more confident about Chinese exports outlook because AI advancement in China, a lot of that will be combined with manufacturing and industrial activity. So the competitive advantage right now is already very sizable. It's only going to get bigger.
Which AI segments are most attractive right now? Would you say health tech or ed tech?
I mean, that is looking into the future. I wish I have the crystal ball to tell you which lane to invest in and where the next 10 bagger is going to be. But I think this is, we have been highlighting AI is transforming technology. It's going to have a big impact in lifting labor productivity and global output. So I wouldn't limit our imagination to a few areas that it could be expanding to many aspects of our lives.
Hui, there's so much uncertainty out there. Which data points would you be looking out for in the next 12 months to decide, the state of the Chinese economy?
Good question. Because the Chinese economy is restructuring, so there are weaker points that you want to manage and you want to watch, including what property prices are doing. Month after month, are they still declining? That will have important impact on sentiment and balance sheet and consumption. At the same time, you're also having this very resilient, very strong export. So container throughput, any kind of a vessel tracking data that we're also watching very closely. And as investors, as market participants, it's important not to just focus on one side of the equation. You got to recognize that this is a restructuring economy. There will be extremely weak aspects of the economy, and there will be extremely strong aspects of the economy. You got to keep monitoring every aspect of the economy.
What surprise upside might we be in for?
if you believe in the thesis that Chinese manufacturing is so competitive and you're going to see exports and Chinese companies going overseas, then in a way China is more integrated with the rest of the world. So to me, the risk is how the rest of the world is doing. If global growth is robust and demand is resilient and strong, then it doesn't matter you get it directly from China or you get it from Vietnam, but Vietnam get it from China. Eventually, we have to meet that end demand. So it's important to know whether globally the growth picture is going to be positive. If we're going to head into a soft patch in global economy, then even if Chinese products are competitive and attractive and a lower price, it is still going to be pretty challenging. So I really emphasize that despite all the decoupling talks, the Chinese economy, because it's so reliant on exports, the interlinkages between Chinese economy versus the global economy is actually getting stronger.
Hui, thank you so much for that. Hui Shan, Chief China Economist at Goldman Sachs, coming to us from Hong Kong. Coming up, Microsoft's Xbox and Sony's PlayStation are long-standing rivals in the video game console wars, but that might be coming to an end. We'll dig deeper into what's changed. Keep it here with us. This is Bloomberg. Welcome back. Sony raised its profit outlook after reporting stronger than expected earnings, boosted by its entertainment portfolio and resurgent demand for its premium smartphone camera sensors. The electronics giant beat analysts' estimates, a sales surge thanks to blockbuster anime series such as Demon Slayer. The PlayStation maker sold 3.9 million units of its flagship PS5 console, higher than it had in the same period in a year earlier. The firm also flagging a smaller than expected impact from tariffs. The company also sold more software for its gaming platforms and more from its first-party studios, though the number of active PlayStation users slipped to 119 million. Long known as a consumer electronics brand, Sony has refashioned itself as a global producer and publisher of entertainment spanning all genres and categories. Sony, Nintendo, and Microsoft have been battling it out for console gaming dominance. However, Bloomberg Opinion's Garode Ridey thinks that rivalry might finally be ending, and not without a bang, but a whimper. That's because Microsoft is finally deciding to bring its iconic Xbox exclusive franchise Halo to the PlayStation. Garode joins us now. Garode, will this really end the console wars?
I think it's hard to say definitively, but we're definitely seeing a shift in the strategies that these companies are employing, particularly Microsoft, which has been struggling a little bit with its Xbox division, also for whom the Xbox division is not particularly important, given how much money it's making off cloud and other divisions at the moment. But I think we're definitely seeing a shift. This decision to bring an iconic franchise like Halo to PlayStation would have been unimaginable, I think, a decade ago. Having said that, Nintendo, they're still very committed to their business model. Obviously, the Switch 2 has just launched. You're not going to see Mario Kart or Donkey Kong on any other consoles anytime soon. But we're definitely seeing, I think, all three companies looking around and deciding what is going to be the future of this industry model, the razor and blades model, as it's known, of how these companies have traditionally worked is breaking down a little bit.
To be fair, you wouldn't think that consoles are a thing of the past, right? That wouldn't happen anytime soon. Just take a look at the sales of Nintendo Switch.
Absolutely. I mean, predictions that consoles will be on their way out have been around for a long time and continue to not come to pass. There's a lot of expectation at the moment around cloud gaming, and obviously mobile gaming is a huge sector as well. Personally, I don't think that the console model is going away anytime soon. We'll definitely see another generation, whether it's a PlayStation 6 or whatever it's called. However, Microsoft in particular are going very hard on this idea that Xbox doesn't have to just be on an Xbox. A PC can be an Xbox. An iPad can be an Xbox. A mobile phone can be an Xbox. So, I don't think we're going to see the dedicated machines go away anytime soon, but we are going to have to, and these companies are coming to terms with the idea that users will go wherever the entertainment is, and that can be anywhere these days.
And in your view, Garode, what is the future of gaming with cloud and AI? Even Netflix is offering games these days.
I would color myself to be a cloud gaming skeptic. I have to say I'm not convinced that the technological issues with it will ever be surmountable, given just the existence of the inherent existence of lag that will affect some games. Having said that, obviously, I think all of these companies, you're even seeing this with Nintendo a little bit, where they're offering now different kind of apps on the iPhone to support the gaming experience. They recently just launched an app where you can see, all the stats for games that you've been playing going way back to the era of the 3DS. And I think, these companies are having to go and meet the consumer where the consumer is, rather than expect they will always just come to them and they'll always just be within, the little console bubble that they have.
I want to close the circle, Garode. Does Halo coming over to PlayStation signal that perhaps Microsoft is conceding to Sony in the console battle?
I wouldn't necessarily put it like that. Obviously, Microsoft have been struggling against PlayStation for some years now. It's been a while since they were at the real forefront of the industry. I think the question is, are they doing this out of choice? This is where they see that the industry is going. They're very hard into their subscription service that they offer, or is it something that they've been forced into because their sales have been struggling a little bit, and as has been reported by my colleagues on Bloomberg News, they are being pushed to have higher profit margins than other sectors of the industry.
Great stuff. Garode Ridey, Bloomberg Opinion columnist, thank you so much for that. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.